at Metropole TVKE across all your social media platforms. My name is Simba Elijah Charles Kiage. Thank you very much for taking your time this morning to begin your day with us. Let me take my time and introduce the panel that is joining us this morning to take you through the biggest headlines that you're waking up to this morning. First, we are joined by Robert Ochieng, who is an investment analyst. I'll be telling you his title soon again. Robert, good morning, sir.
Good morning.
How are you doing? Happy to have you around.
Good. Thank you.
All right. Well, so let me say hi to Josh Ansando, who is a policy analyst. Josh, good morning, sir.
Good morning, Simba. How are you?
Amazing, man. Happy to have you around as well. Let me also take this time to introduce Churchill Ogutu, who is the head of research at Genghis Capital. Churchill, good morning, sir.
Morning to you, Simba. How are you?
Fine, thank you. Happy to have you around. Let's jump into that first story that we have for you this morning. Well, there's something special happening for a little known stock at NSE. I'm talking about Nairobi Business Ventures. All right, now, Nairobi Business Ventures historical price rally at the Nairobi Securities Exchange have staged the biggest short-term rally ever witnessed on the local bourse, which has seen the wealth of its founders jump by hundreds of millions of shillings. Now, the company started trading on the Nairobi Securities Exchange (NSE) in June 2016 with a share price of just 5 shillings, giving it a market value of just 118 million shillings, after which a downward fall saw its share price spiral below 1 shilling in January 2019 as investors reacted to losses and eventual seizure of the company's stores by landlords. But recent managerial and business changes have seen the stock rally its share worth of the company to yesterday's high of 4.42 billion shillings and gained 1,536% over the past year, making it the best performing at the NSE. Now, the market value for the company has however shrunk to 4.4 billion, which is still higher than the value of many companies generating billions of shillings in revenue from ongoing operations. Good. Just before we talk about that, let's look at that daily share price movement for Nairobi Business Ventures. And when they announced those business changes the management changes early this year, we did see exactly how it shot, and that was partly in early of June. You're seeing exactly how they shot before they came back and stabilized in that's share price movement. Same thing that we're going to see in the market cap. Yes, indeed, you can see exactly how it's corresponding to that share price movement. Again, short early in June before they came back and stabilized, which is exactly where our talking points are from this morning. Let me bring in Robert Ochieng first. Robert, is this just a short-term rally, or indeed we are seeing NBV becoming one of those stocks that you have to look at in your portfolio at NSA?
Quite if it is in the same segment as Olympia Capital. So I would say that Olympia Capital is not, and certainly have very good and products. Venture, if you ask me, is typically how the market works is that there's a lot of sentiments, and sometimes sentiments can override value. Yes. So that in the short term, it is the sentiments driving share prices, which we saw in the US with a company known as GameStop. We've seen it with AMC. So we thought that was just like in a movie that you watch in Hollywood. Now it is happening in Kenya as well. So I'd say that's what we have to look at now. Because there are two things. First of all, there has to be value, and still the value has not been validated, even from a management point of view, like having a strategic plan to tell us this is what we have and this is where we are going. So we are thinking on their behalf and deciding that this company is going to do well. Yet, even if we ask them, I don't think it will have solid answers. So it's still a work in progress. I remember when James Wang was launching at Equitel, he gave a very, very good sentiment. He said that Equitel is a work in progress, which is a very sober statement.
Yes.
So I'd say it is a work in progress. The share price has already told us that it has already arrived. It's like is not the case.
Robert, let me catch you in, if I may, this morning. But when you look at the plan that they have in place, number one thing that they did actually shovel their management good, and they gave us big names who are now heading that company. And then they told us that we're not just going to be a shoe company. Now we're branching into other areas of investments. Is that not enough for you to look at it and say, wow, this is a company that is going upwards, especially again after they posted their very first profits, even if they were a bit marginal, but again, that's a company that is looking northwards. Is that not enough?
I agree. Those are very good and solid things that they are doing.
Yes.
But I would just say that turnarounds are some of the most risky investments that you can ever have around. So
yes.
One of the most successful one in our market was Kenol Kobil, and you've also seen Family Bank doing a good turnaround. But look at the rest. Uchumi had very good plans. Remember, they wanted even to do some franchise. So many things. They brought a respected leader. It didn't work. We've seen that across the industry. So it just remains in terms of risk. I would say it is like a wild card. It would be a low probability and high impact event. So high impact can be either way. It can be extremely good or extremely bad. So that's what turnarounds are. So if I were to do it as an investor, I would say that if you have money, if you believe that it's going to gain, let's say 15 times, like now it has done 15 times. So maybe if you put little money and it turns out that way, that's good enough. But again, if you put too much money and it goes the other way around, it will be very bad for you as an investor. But personally, I have a list of shares that I look at, and I'm sorry to say that currently I'm not very keen on the counter because it will distract my investment philosophy.
Pretty much. Bringing Churchill this morning. Churchill, we hear what Robert is saying, that personally he has, well, those talks that he's looking at, and he would want to actually go that direction because it's going to destabilize his investment strategy. But 5 years ago, for somebody who had actually put in 100,000, today they are talking about 1.5 million. Regardless, it looks like that is a good area. Anyway, that aside, let's look at exactly what they're telling us. They're telling us now they want to get into the airline business. Most notably, they also want to get into cement manufacturing. Are those good areas, Churchill, when you're looking at it and then say, wow, it's promising, but are these good areas that the company wants to get into?
Yeah, fair points that you're bringing in this morning, Simba. Looking at even that sector diversification, as you correctly mentioned, that this company was started out as a shoe retail company,
yes,
and now it's pivoting into aviation, cement, and also the transport logistics company. So still wonder, is it that they're trying to bring into place some getting into the value chain of the company, or what's around here? So in terms of a strategy perspective, we are still having some question marks in terms of where exactly the company is going. Will it end up being a conglomerate, or will it which has different portfolio companies? So it's still up in the clouds exactly where the strategy is coming, where the strategy is going. But we are seeing that there's been some revitalization of sorts with the injection of the capital. Remember that the financials that we have for this company, the half year ending September last year, it had a revenue of 71 million. Compared to zero revenue in the comparable period the previous year.
Yes.
And then it had a profit of around 74,000 shillings from a negative 28 million the previous year. So from those comparisons, the company itself is in a negative position in terms of equity. So it needed that equity injection. But then we are having capital injection that came into the company. We have a new big shareholder, Delta, EPZ, Delta, having a significant stake in the company, and then coming up with these new investments. And even the costs, the company is still in a negative equity position. The cost of this acquisition is 3 billion. We're still struggling to find how they'll be able to go about that. So we're still at a crossroads, and as Robert has said, in as much as it has had that meteoric rise, somebody who held these shares on the eve of this transaction around mid-October last year, it was trading at 71 cents. It went to as high of 12 shillings and 80 cents. So that's a cool 1,700% return in under 7 months. So that's quite meteoric, but still, there's still some question marks around the strategy that could now lead even to some more uptick even going forward.
Pretty much. So, Churchill, what would you be advised? Should somebody ask you whether to put in or to hold? Is it to hold or to put in? Because indeed, with 100,000 investment and with the share price just going for around 12 shillings, you are really going to buy much into the company.
Well, at least at this point in time, we are seeing liquidity has improved in the company.
Yes.
Because of additional number of shares that were brought into the company. So we're seeing liquidity improving. We're not seeing that even the price changes is just what we call fat finger trips, by just some erroneous 100 share price or 100 share leading to something north of 10% in any given day, but we are seeing that it's because of high liquidity. So from that perspective, right now, even from an analyst or somebody who's looking at this company, at least you can see that, well, the volumes are enticing, that if you get into the company, at least there are chances of you getting out. So that's one. But in terms of the recommendation, which direction we'll be looking at, I think at this moment it's still a hold until we get a clear strategy from the management. What we saw at the beginning of this month was just an announcement of these 4 companies to be acquired, but you haven't seen the drill down into the specifics, how it will work out. So up until that moment that we see much more information around these acquisitions is when we can now be able to give a convincing recommendation on the counter.
Pretty much. Robert, just before we jump into the next one, in a minute, if you may, you say something good, which might not be good as well for somebody looking at you. Now, you say, well, the sort of stock that you may want to look into, because then it's going to destabilize your investment strategy. But when we have these smaller stocks, these little known stocks that have historically not gone through this type of gain, is it not good for our market? Is this not what we need, Robert?
Yeah, I think it is a good thing, especially from a liquidity point of view.
Yes.
We need as many people as possible trading. The excitement is part of the market, and you can't really control people's behavior and what they are going to do in the market. Free market, but I'll just send a word of caution that, in my view, it should be, I'll call it a wild card. So if you're going to do it, put in something that you can afford to lose, and if indeed it is going to gain by 15 times, then maybe your 100,000 only can become 1.5. But if you put in 1 million and let's say it goes the other way, your 1 million can become 10,000, which you've seen in counters like Home Africa. So it's just good to be guarded, if you ask me.
Pretty much. So what turnaround will you want to give NBV? What turnaround period will you want to tell anybody listening to you this morning to give this particular stock?
I think when you look at investments, minimum 3 years to see the direction, then from 5 years, the 5th year, you might start seeing results. So just look at a company like Equity, the Equity 3.0 strategy. They started working on it in the year 2013, and now we are seeing massive results. Just mind-boggling. And Standard Chartered, they started working on their wealth fund in the year 2013, and they just hit 100 billion last year from nothing. So you see, that's 7 years. So you have to be realistic. Nothing is going to happen overnight.
So you gotta be realistic. So invest less as you hold on and see exactly what happens?
Yes, as you see the focus comes to realization and the direction becomes clearer, then you can keep on adding more. So you can do what they call dollar cost averaging.
Pretty much. All right, gentlemen, let's move on to the next issue this morning. Why economy analysts now say that the Central Bank of Kenya CBK Monetary Policy Committee, which is expected to meet today, again saying will be expected to set the CBR unchanged at 7%. Analysts now say that inflation expectations still remain anchored well within the limit despite the disruptions of the COVID-19 that are being felt. They say international bodies like the International Monetary Fund and the World Bank have already cut back on Kenya's economic growth chances and put Kenya's economy recovery on the first rollout of the COVID-19 vaccination program. Keenly watched will be inflation figures to be released on 30th of June 2021 and the results of the weekly Treasury bills auction to be held this Thursday. As fine then, Churchill, let me ask you this question like any other person can ask you. Or just before that question, let's look at exactly where we've been. There's that magic 7. There's no need to see other months because it's actually been put there at 7%. Now, we're saying again that it might go back to 7. Which therefore begs this question, Churchill. Have we lost any significance in this tool? Is it as useless as it can get?
Well, it's not as useless as EA in T, the spelling of TEA, so it's not that useless. Yes. But in terms of transmission channel, if you think about CBR, it's ideally a signaling rate in the extent that it's meant to influence short-term rates. Think of interbank rate or even think of the T-bills. So based on where the CBR rate is currently is at 7%, so that is indicative of even T-bill yields. But obviously, there are some other factors that come at play. So at the moment, with the CBR at 7%, you see that 91-day T-bill, 1H2-day T-bill is at below 7%. So there's that market that, wait a minute, if the CBR is supposed to be like a benchmark rate, is at 7%, but then we find other T-bill tenors below that benchmark rate, and then the 364-day is slightly like 0.4% higher than the CBR rate. What's going on here? So in terms of its transmission channel, it's been a bit slow, but then of course we are looking at the context at current environment, whereby there's been high liquidity in the banking sector to the extent that the CBK has been having some latitude in terms of rejecting aggressive bids and been the function of the T. But nonetheless, back to your in terms of its monetary, its effectiveness, it's not been that effective. And to be sure, yesterday the CBK released a white paper. This white paper was expected to be released sometime end of June.
Yes.
It's been released. It was released yesterday. Just coming up with proposals or measures from the CBK Monetary Policy Committee's perspective in terms of modernizing its monetary policy, and with that to ensure that there's some effectiveness with the CBR. So that is what we expect will start playing in the near future as it implements these white paper recommendations.
Yes, but Churchill, let me just ask you that same question again. With somebody looking at that figure, 7%, I mean, we went into the COVID-19 pandemic, we stuck at 7%. We sort of came out of the COVID-19 pandemic in 2021. We are still at that 7%. You would like to think if a tool is effective, then you'll also have a change in that number as you push towards a certain direction. The only thing that the CBK keeps on, the only indicator that we keep on getting from the CBK is just one, inflation. But then we do know there are so many other indicators, especially when you want that tool to even drive lending within the MSME sector. It looks as if we are held by the physical indiscipline or discipline, depending on what side of the balance you belong to, as to why we can't move out of that 7%. Is that what it is?
Just to clarify, around March last year, the CBR rate was at 8.25%.
Yes.
And then because with the threat of COVID-19, there was that an emergency meeting, or rather it was a scheduled meeting, and then it reduced it to 7.25%. And then in April 2020, they reduced it further to 7%,
yes,
where it has been. So the impact of 7% of that reduction was at least to be able to ensure that there is robust credit mediation to the risky borrowers within the context of COVID-19. But if you look at the statistics, the private sector credit growth, we haven't seen that robust credit mediation in terms of where the private sector credit growth is. So that, to your first question, also just tells us that effectiveness has not been that robust, and that just leaves credence. Okay, should we still stick at 7%? Or is there some scope at reducing it further? But then there are some risks of, even if you reduce it further, remember that even the deposit rates by the banks, they are somehow influenced by the CBR rate. So there's that risk that from a CBK perspective, if they further reduce it, in anticipation of at least ensuring that there's robust credit mediation, they further risk distorting the stability of the financial market. So that is where I find that the MPC meeting is stuck in between a rock and a hard place. So more likely than not, they just end up having a neutral stance, hence the 7% during this whole COVID-19 period.
Pretty much. Robert, I just want you to weigh in just a minute of whether it's as effective as it should be or it ought to be, and when you think that this situation that Churchill is describing this morning, that they're stuck within a hard place, within a, wow, what's that phrase? Wow. It's wow. All right.
A rock and a hard place.
It's in a rock and a hard place. Woof. Is it effective as it should be? And should we just look at the physical side of things and then say, this is what the bottleneck is?
Yes, so I think what you can look at, first of all, like Churchill has put it very well, is that it's just a signaling rate. And I'm sorry to say that is the only thing that it is now.
Yes.
Because you have to remember that the rate cap is not in place anymore now. So there's no way that it will affect lending. It is just a psychological barrier that we are still assuming that there's the interest rate cap, but actually it is not there. I know there are challenges in the industry in terms of CBK saying that before you can increase the lending rate, you have to consult them. There are discussions on risk-based pricing of loans, but legally it doesn't matter when it comes to lending. So it's just that psychological barrier that we are still fighting. But we've seen the challenges in the market. We are in a position whereby we are pushing for the banks to lend to the private sector, but the same people are saying so, probably they've forgotten where we are in terms of non-performing loans. So I think banks are not in the business of dishing out loans. So you have to know that there's risk, and you have to look at the current non-performing loan is in the range of 12 to 13%. That means that if you lend 100 billion, you are not going to get back 13 billion. So if you are a bank CEO, what would you do? So that is the situation they are in, and we see that there's a lot of there's increased appetite from the government in terms of borrowing. Now there are bond issues whereby the government is planning to raise 60 billion. So if you ask me, if you are bank CEOs, what would you do if you are going to get 13% or 12% from an infrastructure bond, and yet a private institution is likely not to give you back your money that you disbursed to them? So if you ask me from that point of view, TBR is just a signaling rate, like Churchill has said. But from a lending perspective, there's nothing that it will do to the private sector. Banks are not going to lower the lending rate, even if CBR is lowered to 5. Yeah, so it's just to signal, and maybe if the people use that tool, because I've seen like even the family bank notes that they had previously, they are benchmarking them on the T-bills. Like there's an indirect correlation. If the T-bills are going to rely on CBR, then indirectly it is going to affect some of these bonds that you have. So it is not like a direct match, but indirectly it can affect some instruments in the financial markets. We've seen they are actually lower than the inflation of the 1 day and 365, 364 days. They're just barely 1.2.
Yes.
Above the rate. That doesn't look good for depositors. So we are running out of options as investors. We are looking for low risk investments. So probably money markets yields will affect them, and they're getting lower. So probably you look at infrastructure bonds and long-term bonds as some of the best low-risk investment. So that has got an effect on investors and what we get at the end of the day.
Pretty much. Gentlemen, I'd like us to take a short break. Once we come back, remember we still have Josh with us today. Now, Welamulo Dinga is saying that we need to adopt a different policy just to rectify civil service in the country. And he's saying that maybe take everybody who works in civil service, let them do some time in the private sector, and then bring them back to the civil service. And he's saying that is exactly what is going to make civil service in the country tick. Is that going to be possible? Still, on markets in the country, equity markets, how are they looking in a 2021? Because we're still seeing that seesaw that we saw in 2020, actually way back even before 2020. Where are we looking once we come back here on a business